Understanding IPOs, a guide to initial public offerings and initial public offering. IPO is the process by which a private company first offers shares to the public, essentially going public. This is a pivotal moment for businesses seeking significant capital for growth, debt reduction, or increased credibility. But what does it mean for investors, and what risks are involved? How IPOs work. A step-by-step breakdown the journey from private to public involves a structured process. First, the company must evaluate its readiness, ensuring strong financials and transparent governance. Next, they hire investment banks, underwriters, to assess valuation, determine the number of shares to sell, and market the offering. The company then files with the Securities and Exchange Commission, SEC, submitting a detailed Form S-1 registration statement outlining financials, business models, and associated risks. Before the sale, companies conduct a roadshow to gauge investor interest and finalize pricing. Finally, once approved by the SEC, shares are listed on an exchange, where trading begins, creating a public market for the stock. Why companies choose to go public? The primary driver for IPOs is access to capital. Going public unlocks large-scale funding opportunities unavailable to private companies. This influx of capital can fuel expansion, research and development, or the repayment of existing debts. Becoming a publicly traded entity also boosts visibility and credibility, attracting wider investor interest and potentially improving brand recognition. Investing in IPOs. Access and risks. Participating in an IPO isn't as straightforward as buying established stocks. Investors must typically open a brokerage account with IPO access and meet specific eligibility requirements. The process involves reviewing the prospectus and submitting an indication of interest, though allocation isn't guaranteed. Institutional investors, large funds and banks, often receive priority access, making it harder for retail investors to secure shares. The biggest risk is volatility. IPO prices can swing dramatically on the first day of trading. New public companies also lack long-term performance history, adding uncertainty. IPOs versus traditional stock, investing the difference lies in risk and information. IPOs are inherently more volatile than established stocks. You're investing in a company with limited public track record, relying heavily on projected growth rather than proven results. Established companies offer stability, while IPOs offer the potential for high reward and high risk. A real-world example. The tech startup path. Consider a tech startup preparing to go public. It sets an IPO price, investors purchase shares, and the stock begins trading on an exchange. The price then fluctuates based on market demand, sometimes skyrocketing, sometimes falling below the initial offering price. This illustrates the unpredictable nature of IPOs. Should you invest in an IPO? If you're new to investing, avoid early IPO participation. The volatility is too high and access is limited. Wait for the stock to stabilize after the IPO launch. If you're seeking long-term growth, established companies or index funds are generally safer bets. Ultimately, an IPO is a high-risk, high-reward venture. Proceed with caution, do your research, and understand the volatility before investing.